Good morning. Today, we, the members of Team 6, are going to present our strategic analysis on retail banking industry. And for this, we have taken two particular companies, HDFC and ICICI Bank. The panelists present in the meet will take us through the industry and the company analysis through various lenses and will be able to tell the industry structure and how different factors affect the industry and the companies. Right now, I'll be sharing the screen and sharing the presentation with you all. Over to you, Kuldeep.
Thank you. Thank you, Samadeep. So, any modern economy's lifeline is the banking industry. Thus, a country progress is directly related to the development of banks. Banks are to be regarded as the development leaders rather than the money sellers in a contemporary economy. Indian banking system was started in 1921 with the establishment of Imperial Bank of India, which is currently known as State Bank of India. In year 1935, the country's central bank called Reserve Bank of India was established, which regulates the banking industry in the country. Over the 100 years of span of Indian banking industry, many public sector bank, private sector bank, regional rural banks, foreign banks, and cooperative banks established. Currently, there are 12 public sector banks, 22 private sector banks, 43 regional rural banks, 44 foreign banks, and 97,484 cooperative banks are working under the supervision of Reserve Bank of India. So, coming to the growth drivers for Indian banking system, first is economic and demographic driver. India being the fifth largest economy, and with the rising income levels, banks are solely responsible for the economic development and stability in the country. Second, political support. Indian government has given full powers to Reserve Bank of India for all the amendments and keeping a check on the performance of the banks. Third, infrastructure financing. India spends about 6% of its GDP on infrastructure, which requires low-cost capital, estimated up to 20 lakh crore every year from Indian banks. For next is open banking system ecosystem. India has allowed NBFC and other fintech players to serve banking to the Indian people. Fifth, cross-border payment. With MasterCards and Visa services and through SWIFT transaction system, Indian banks can perform quick border payments very easily. Sixth, government initiative. Government has invested heavily in banks in order to maintain the regulatory capital requirement and thus keeping Indian economy growth steady. Next slide. Coming to the profitability of banking institution is determined by adding the net interest income with other income and reducing the operating expenses and keeping a provision for the bad loans. Next slide, please.
Let's analyze the industry's external environment with the help of questionnaire analysis. Our first parameter is political factors. The main political factor is political stability in the current markets. Because the banks work in several countries, strategies must be developed for each nation based on the regional bank's industry-specific criteria. Another major political factor is taxation policies. Over the last 2 decades, retail banks in Western Hemisphere have benefited a lot from lower taxation policies. It has led to the increased revenue and investment in research and development. Rising inequality in India may force adjustments in taxation policies in future. Another governance and regulatory practices are also important factor. A bank must handle a variety of rules for many markets in which it operates. To forecast the trends, banks must keep a close watch on industry-wide government initiatives. And another factor is the importance of local governments in India. Unlike most other nations, local governments in India play an important role in policy making and regulating. Rather than developing nationwide strategy in India, banks must constantly monitor the states in which it has presence. Our next parameter is economic factors. India has started investing heavily in their core infrastructure availability. Over the years, Indian government has expanded the investment in creating core infrastructure to enable and improve the business climate. Banks may use the existing infrastructure to support expansion in the Indian financial industry. And another major important factor are the exchange rates. India's exchange rates are very unpredictable and they can have a long-term impact on retail banking investment. Also, for economic performance in India, I anticipate that India's economic performance will stay constant for the next 5 to 10 years due to government spending and stable demand due to disposable income and increased investments in new industries. The next parameter is the social factors that will influence. The main social factor is the gender roles and demography. The gender roles in India are changing and private banks must experiment with different strategies to adopt to and support the changing gender roles in Indian culture. Bank has a demographic advantage on their favor. India is a young and developing country. Banks may take advantage of this trend to reach out diverse parts of the public. The social norms in India are very different. So to better service the clients in India, banks should try to establish local staff who knows the local social and norms. for better services. Another parameter is technological factors. The advancement and spread of mobile technologies have altered the client expectation in the financial sector. To stay ahead of the competition, private banks must not only fulfill and manage the expectations, but they should also innovate their digital banking solutions by lowering the production cost. New technologies are rapidly reducing the production and servicing cost in financial sector. Private banks must rearrange their supply chains to increase flexibility in order to suit both clients' requirements and cost structures. The next parameter is environmental factors. In an Indian economy, recycling is quickly becoming standard rather than an exception. Private banks must establish strategies to comply with financial industry norms and expectations. Apart from that, the customer activism is also an important factor, in which increased customer awareness has pushed environmental considerations to the forefront of the bank strategy. Customers want bank not to adhere, but also surpass the legal criteria in order to become the responsible community shareholders. And last but not the least are the legal factors. The length of the time it takes to resolve the business matters in courts for some nations, although adhering to the international standards, but takes years to resolve the cases. Before entering to any new international market, private banks must carefully analyze the average time take to for certain instances. And the next fact, another important factor is data protection laws. Over the last decade, data protection has developed as a vital component of both privacy and intellectual property rights. Private banks must assess if India has a solid process in place to defend against these data breaches. Next slide, please.
Next is Porter's five forces. Threat of new entering. Banks are fearful of being squeezed out of the payment business because it is a good source of fee-based revenue. Another trend that poses a threat is companies offering other financial services. Also, when analyzing a regional bank, remember that the possibility of a mega bank entering into the market poses a real threat. In Indian banking industry, the main threats are foreign players and non-banking finance companies. Suppliers part. The suppliers of capital might not pose a threat, but the threat of suppliers luring away the capital does. In Indian banking industry, RBI acts as a regulator, which poses a big threat for the banks as a supplier of the money. Next is buyer's power. The individual doesn't pose much of a threat to a banking industry, but one of the major factors affecting the powers of the buyers is relatively switching cost. In attempt to lure in customers, bank try to lower the price of the switching, but many people will still rather stick with their current bank. On the other hand, financial institutes, by offering better exchange rate, more services, and exposure to foreign capital market, work extremely hard to get high margin corporate clients. Next is availability of the substitutes. Banks offer a suite of services over and above taking deposits and lending money. But whether it is insurance, mutual funds, or fixed income securities, chances are there is a non-banking financial service company that can offer similar services. Next is competitive rivalry. Banks industry is highly competitive and bank must attempt to lure clients away from the competitive banks. They do this by offering low financing, preferred rates, and investment services. The banking sector is in a race to see who can offer both the best and fastest services. But this also causes banks to experience a lower ROE. Larger banks would prefer to take over and merge with another bank rather than spend the money to market and advertise to the people. Next slide, please.
Value chain analysis. The banking industry value chain starts with the customer. The rest of the value chain is comprised of a series of value generating events and activities. So banks fill a market need by providing a service and earn a profit by charging customers for that service. The key commercial banking activities are taking in deposits from savers and making loans to households and firms. Banks earn money from various sources, but most of the money comes from lending. When banks lend the money, they earn loans interest, which is paid to them by the borrowers of money. Traditionally, this has resulted in the main functions of commercial banks being accepting deposits from the public and advancing them loans. However, besides this function, there are many other functions which these banks perform to earn additional revenue. These functions are first, spreading the wealth. Transferring money back to provide growth and stabilizing the monetary supply are important functions performed by banks. Second is issuing money. Bank issue money in the form of banknotes in current accounts subject to check or payments at the customer's order. Third is payments agent. Bank acts as payment agents by conducting checking or current accounts for customers, paying checks drawn by customers on the bank, and collecting checks deposited to customers' current accounts. Fourth is money transferring. They move it between banks and individual customers, between banks and industry, between banks and governments, and sometimes between governments. Sometimes the sum involved are huge. This motion of capital throughout the nation and the world allows business to have access to capital. Fifth is distribution of funds. The industry players produce an assortment of services from saving accounts to homes and business loans and mortgages. Sixth is safeguarding money. Bank offers vault or a safe deposit box when you think of safeguarding money. And the last is record keeping. Record keeping is an important part of securing your money. Bank devotes much time and attention to both the practice and technology of maintaining and storing accurate records. Next slide, please.
Okay. So now let's just quickly identify the critical success factors through profitability model. And for this, we have used three models: return on sales, return on equity, and return on asset. For return on sales, it is defined as the difference between the net interest from borrowers and the net interest to depositors. Based on this principle, we have identified three primary critical success factors. Customer satisfaction. Since the profitability is dependent on the number of retail customers that visit the bank for lending or borrowing, it is important that the bank keeps attracting more and more customers. Thus, customer service becomes a crucial factor on which the success of the bank depends. Product and service mix. Increase in the number of services provided by the bank will attract more consumers, and the ease with which these can be carried out increases the cash flow as well as the profitability. Third, and the most important, is decreasing the probability of non-performing loans. By increasing the number of checks before giving loan to lenders, it will decrease the probability of non-performing assets. Lastly is the location. By building banks branches in locations that have the ability to maximize customers per square foot, the company can ensure higher chances of customers depositing as well as lending. Next slide, please.
So I would like to take you through the other two critical success factors, that are the return on equity and return on asset. The return on equity formula is net profit after tax divided by the total equity shares. And the return on asset formula is net profit after the tax divided by the total asset the organization has. So the critical success factors that both include are: first is spread ratio. That means the ratio of money a bank receives to the money it pays out. We must increase our spread ratio, leading to an rise in our ROE. The second one is credit deposit ratio. Deposits are the sum that bank receive from consumers as deposits. And it is the bank's current ratio, that is the asset upon liabilities. To increase ROE, we must have higher CDR. The next one is operating expense. The continuing costs a company incurs as a result of its regular operation are known as operating expense. We must reduce our OPEX to ensure higher profitability, which would ensure that we have a higher return on equity and a higher return on asset. The next one is non-performing asset. They are the loans and advances that are in default or in arrears and are classified as non-performing asset or NPA. We must avoid creating such NPA in our balance sheet. The next one is non-interest income. Banks and creditors' non-interest revenue include fees such as deposit and transaction fees, NSF fees, annual fees, etc. And we must try to increase our non-interest income, which will help us to increase our profitability and the return on asset and equity. The next one is amount of the loan. So we must try to increase the amount of the loan that we disburse to our customers. The next one is switching to various other alternative sources of funds such as preferences and debentures, which would reduce our equity shareholding and increase our ROE. The other factors are provisions and contingency, investment deposit ratio, and capital adequacy ratio. Next slide, please.
So let's now talk about the organizations. Our first organization is HDFC Bank. It is a Mumbai-based Indian bank founded in 1994. As of September 2022, it is India's largest private sector bank by assets, with a market value of $104 billion. With about 150,000 employees in financial 2022, bank has standalone revenue of $22 billion, and it has issued 23.5 billion debit cards and 12 million credit cards. According to RBI, they considered HDFC to be too big to fail because of their huge size. Our next organization is ICICI Bank. It is formerly known as Industrial Credit and Investment Corporation of India, which was founded in 1994. It is Indian International Bank, which is headquartered in Mumbai. It is third largest bank in India with a market value of $80.2 billion. As of September 2022, ICICI Bank has standalone revenue of $20 billion, and ICICI Bank is also emerged as the best employer in India for banking and financial sector according to Forbes list. Next slide, please.
Now let's go through the corporate strategy of both the banks. Now the corporate strategy is basically determined by three decisions: product scope, geographical scope, and the vertical scope. So starting with the HDFC Bank and the product scope of HDFC Bank, it is divided into three categories: wholesale banking, retail banking, and the treasury. When it comes to geographical scope, due to the high availability, adaptability, and usage of technology, what we are seeing is that these are the places is usually semi-urban and rural places have used technology quite a lot, and thus there arises an opportunity for HDFC to make profits in there. Next, coming on to the vertical scope, this is divided into three parts: commercial and rural. The commercial and rural strategy, which includes emerging corporates, mid-market corporation, commercial agricultures, are one of the few pillars of the bank's overall strategy. Corporate cluster. The corporate banking division of a bank provides thorough banking solutions to businesses in all fields and industries. Lastly, the digital marketing. This is one of the most important features. The company is using digital marketing to promote knowledge of financial solutions and foster brand loyalty among customers. Apart from that, it is helping them establish omni-channel as well as helping them personalize the user experience. Next, coming on to the ICICI Bank. For the product scope, what we see is that ICICI has launched a huge number of products ranging from ICICI Lombard General Insurance as well as Prudential Life Insurance. When coming on to the geographical scope, it has 5275 branches and 15,589 ATMs spread across 17 countries. Lastly, the vertical scope. In the marketing section, ICICI does its marketing through film, advertisement, TV, print, online commercials, etc. Transactions. Through the use of technology, ICICI has really come leaps and bounds in making the transaction easier, faster, and accurate. Things like touch banking, smart wall, instant credit. These are few of the services that really helps the bank. The third point, that is the sales. As like HDFC, ICICI also has the omni-channel campaign management. Moving on to the next slide.
I would like to take you through the business strategies of both the banks. So the first, I would like to take you through the business strategy of ICICI Bank. So they have technological progress. They have comprehensive array of financial goods and services that they provide. They have two basic motto, that is fair to consumer, fair to bank, and one bank, one ROE, which is the basic business strategy that they follow. And the last but not the least is the customer centricity. They focus very much on the customer services. Now I would like to take you through the HDFC Bank business strategy. So they use universal banking based synergies to take the benefit of economies of scale. They have a strong client orientation. They also have a broad range of financial goods and services. And for customized services, they have HDFC Bank Plus. Next slide, please.
Talking about the organization capabilities, organization structure at ICICI Bank, they have a strong organization culture of meritocracy, excellence in execution, and high standard of professional integrity. Whereas HDFC Bank culture reveals that the company is more closely related to the disciplined work culture with vertical hierarchy and tall structure. Next is customer connectivity. Both the banks have customer care centers that offer complete support in any case of feedback, problem, or any problem related to the service. Next is innovation. In the fast-paced and constantly moving world, what is cutting-edge innovation today become a thing of past and tomorrow. Over the years, ICICI has changed the way they communicate, pay, shop, and do businesses. While with the aim to speed up the product innovation, the largest private sector lender, HDFC Bank, has started creating dedicated teams by taking executives from various business functions to execute different projects. Next slide, please.
So bank provides different bank services to attract customers, from giving loans, credit and debit cards, digital financial services, and even personal services. However, some essential modern services are offered by most commercial banks. Few of them are listed below for HDFC banks and ICICI banks, such as NIRA banking, personal loans, home loans, deposits, loans, cards, insurance, DMATs, NIRA services, as well as online services. Next slide, please. Thank you so much.